Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from OB3 to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 compliance, provision, and modeling calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in Washington, D.C., in PwC's Policy on Demand studio, where I'm excited to have Raza Janjua. Raza is a director in PwC's International Tax Services practice in New York City and the author of the recent Tax Notes article, Safe Harbor in Stormy Waters, Hybrid Arbitrage Arrangement Guidance. Raza, that title's a mouthful, but welcome to the podcast. It's great to have you on.
Thanks, Doug. It's a pleasure to be here.
All right. So maybe before we dive into hybrid arrangements, and I'm going to warn listeners, this is a highly technical topic. We've covered it on a few podcasts in the past, but I just want to say I think you did an outstanding job with the article. I think you laid out some of the issues that are inherent in having these hybrid arbitrage arrangement rules. But before we dive into that, Raza, what's your background and how did you get into international tax? I've been doing a series on international tax as a profession. Maybe let the listeners know what's your education background and how'd you get into international tax?
So thanks, Doug. Thanks for the compliments on the article, and I apologize for the convoluted nature of the article.
Not your fault.
Yeah, I'll blame that on the inclusive framework. So my background, I grew up in Pakistan and I came over here for college to the United States. And then I was working in the real estate practice and as part of PwC in Chicago. And 2017 came around and the Tax Cuts and Jobs Act was being enacted. And I was very interested as part of the legislative process as to what these provisions were that were being enacted. And being from a foreign jurisdiction, growing up in an international environment, international tax seemed to be the right mix, which would give me an international exposure to the current events, and then at the same time becoming a little bit more of a tax nerd.
So how long were you in the real estate practice before you decided to make the pivot to international?
So I was in the real estate practice for 2 years. I then shifted over to our international tax services for financial services practice, and then I moved to the international tax services core practice. And then I came on tour to our DC office for a couple of years, and then after that, now I'm in my New York City role.
And did you proactively seek out when you were in the real estate practice and say, hey, I want to go do international?
That's right. Yeah, I wanted to do international, and I was seeking that out. And then we had this thing called the International Tax Academy. And as part of that, I was one of the candidates. It gave me the opportunity to transfer over to the international tax practice.
Well, I think it's a great lesson, particularly for the young listeners or people earlier in their career. If you've got a passion, go chase it, ask. Yeah. And many of us work in large organizations with lots of different opportunities, and I always advocate to be proactive and follow your passion. And if there's something that you're interested in, do it. You're a great example. All right, so let's move in, and before we dive into some of the technicals, maybe I'll ask you just what is a hybrid mismatch and why are policymakers so focused on hybrids?
Yeah, and I think the way I view them is essentially, it's basically an instrument that allows you to base erode a jurisdiction without having a corresponding increase or increase in taxable income in another jurisdiction. And as we go through today's podcast, we'll certainly see how these have evolved over the course of the last decade.
Right. So let's start there, because this has been 10 years in the making. It was as I was going back through this and reading your article, it's hard to believe it was, I think, October 2015 when there was BEPS Action Item 2. So maybe we start with that, with BEPS, and then we'll go into actually when this got enacted legislation. But what was BEPS Action Item 2? And talk a little bit about kind of the origins of this.
So even a couple of years before that, right, the G20 finance ministers basically called upon the OECD to address these base erosion and profit shifting concerns. And that resulted in 15 action items, which were sort of presented in this action in this BEPS report. And we go from there, and it takes the OECD and G20 about a couple years to finalize this report, which is called the Hybrid Mismatch Report, which specifically addresses action item 2 of the 15 action items, and action item 2 is addressing hybrid mismatches. They follow that on with another branch mismatch report, which sort of addresses the same concerns when branches are involved, and you start seeing from there on an implementation in various legislations.
Yeah, and the reason I wanted to point out the history, and then I want to talk about the legislative adoption, is that many of the issues that you raise in your article that are relevant for Pillar 2 are the same issues that were raised 10 years ago when this hybrid mismatch report was released. So talk about the legislative adoption, and specifically ATAD 2, and then we also saw some of this within the US within the TCJA.
Yeah, so that's exactly right. This whole thing starts over here with respect to hybrid mismatches, and we see a lot of even the same terms being used now in Pillar 2 safe harbor guidance. But as part of the legislative process, in 2017 we see in Europe ATAD 2,
the Anti-Tax Avoidance Directive.
Anti-Tax Avoidance Directive, and that requires jurisdictions to start implementing these hybrid rules in their legislations, starting January of 2020. And on the other side of the pond, in the United States, we have the Tax Cuts and Jobs Act, which enacts our Section 245 Cap A, which is basically the participation exemption system for the United States companies, and then 267 Cap A, which is essentially the hybrid rules that counter deduction on inclusion outcomes for U.S. multinationals.
Yeah, and I think that the U.S. piece sometimes gets forgotten in the conversation, that there are very specific rules that we have in the U.S., and we also have a whole series of other rules, dual consolidated losses, and we're not going to bore listeners with all the mechanics of the U.S. But it's important to note that both our participation exemption as well as just general deductibility rules have very similar concepts within the U.S.
Yeah, that's right. And those dual consolidated loss rules, they've been there for decades now. So the U.S. was, sort of the first mover on these types of issues.
It's a great point, particularly the deduction, non-inclusion type of policies. All right, so then let's talk about Pillar 2. So we know in December 2021, the Pillar 2 model rules were published. There were no specific hybrid rules, anti-hybrid rules in that, but there was this section that everybody refers to as 3.2.7. What is that, and what did that do under the model rules?
Yeah, so that's probably OECD Inclusive Framework's first attempt at prevention of base erosion and profit shifting with respect to the model rules. And what that tries to do is it prevents low tax jurisdictions being used as a base erosion mechanism, so that you introduce income in a high tax jurisdiction where even if you didn't have a tax increase in the high tax jurisdiction, you really wouldn't have an impact to your overall GLOBE calculation. And on the other side, on the low tax jurisdiction, you would basically achieve blending of ETR, which would increase your ETR in that jurisdiction.
Right, and so they obviously, when the model rules were written, those policy concerns were brought in, but there were no specific, and currently are no specific anti-hybrid rules, but we'll come back to that. So in December of 2022, the OECD announced simplified safe harbors, and then a year later, in December of 2023, those safe harbor rules became more complex with the hybrid arrangement analysis. Tell us a little bit about the safe harbor and why the anti-hybrid rules came in with respect to the safe harbor.
Yeah, so the origin of the simplified safe harbors is essentially a simplification for the Pillar 2 rules, because the Pillar 2 rules are complex and multinationals needed to adapt their operating systems to have all those data points required for those calculations. So we were provided these safe harbors, and there's essentially 3 safe harbors, one of which is a simplified effective tax rate test, in which you derive your numerator, the numerator of the covered taxes from your financial statements, but the denominator you can extract out of your country by country reporting filing. And so that was basically the simplified safe harbor. Now, as part of the simplified safe harbors, the OECD Inclusive Framework became aware essentially of apparently hybrid arbitrage arrangements that that taxpayers were using to basically benefit where the OECD thought there was erosion concerns. And so we got these things called the hybrid arbitrage arrangement rules. And those include, multiple categories of items and what could constitute a hybrid arbitrage arrangement.
Right. And there were a number of retroactivity concerns. What I think is important, because we're going to dive in and unpack these various hybrid arbitrage arrangement rules, is that currently they only apply for purposes, as we're recording this in the summer of 2025, they only apply for purposes of the safe harbor. But the OECD has come out and said that they intend to introduce these rules into the model rules, presumably through some form of administrative guidance at some point in the future. I will note that all of those promises were done before the G7 agreement.
That's right.
And we know that taxpayers are also anxiously awaiting a permanent safe harbor. So it feels like the list of administrative guidance that needs to come out keeps getting longer and longer. But we do know that it is their intention to bring these rules into the full model rules.
Right, and as you said, right, that was the intention before the G7 agreement, and we will talk about what the intention looks like after the G7 agreement. Right. But you're right in saying, these hybrid arbitrage arrangements, when they were released, they came out in December of 2023, and there was a note made that these should be adopted in jurisdictions a year prior when the safe harbor guidance was released, and there was retroactivity concerns about that, whether jurisdictions could even do that. We've seen implementation of these starting now in various jurisdictions such as UK, Ireland, etc. So these are coming online now, but they only apply within the context of safe harbors.
Yeah, and this is a great point, and I probably should step back and remind listeners that, listen, this stuff that comes out as administrative guidance is not law until it actually gets enacted. We've seen this on a whole, we've talked a lot about this on the podcast in the past. There are a number of jurisdictions that are unable constitutionally to be able to bring in this guidance, do it retroactively. These are the same concerns that we have with the G7 agreement, any type of administrative guidance that's going to be coming out. That will be subject to a different podcast. But these issues, have been here throughout this entire Pillar 2 process. They've raised their head with the hybrid arbitrage arrangements for the safe harbor calcs. They're going to continue to be a challenge. Maybe the other point that I would make before we dive into some of the hybrid arrangements, and would love your views on this, I feel like with Pillar 2 that these hybrid arrangements are even more complicated. I mean, this was so complicated with ATAD 2, and we had podcasts on this back in the day on the ATAD 2. With ATAD 2, when they're dealing with hybrid arrangements, it's generally just tax principles that we were dealing with. In other words, you have a deduction the way you explained it in one jurisdiction, maybe another jurisdiction that doesn't include the income, but you were just looking at how does each of those jurisdictions from a tax perspective treat that item of income and item of expense. With Pillar 2, we now have a second layer, right? There's how are the jurisdictions treating it from a tax perspective, but we also now need to look at how are things treated from a book perspective. So it's almost sort of two separate lenses that you now have to view the hybrid arbitrage arrangements for purposes of Pillar 2.
That's absolutely right. We had this two-dimensional creature, which has morphed into perhaps a 3 or even 4-dimensional creature now, and which takes into account book results. And then even within book results, you could be looking at book results under different financial standards.
Yeah, absolutely, because you can, so that even adds another dimension, right? It's a great point. So you have to deal with the tax, you have to deal with the book, but then the book may not necessarily be symmetrical because one jurisdiction may use one financial accounting system of record, another will use a potential other financial accounting system.
That's right.
All right. So now I want to go into and start to unpack some of the specific hybrid arbitrage arrangements and really the purpose of this. And I think you did just a great job in the article that, as we've been working through these with taxpayers, there are just a number of traps for the unwary that go much beyond, I think, what the intention of the rule was to apply. And you laid out some really good examples. You had some good diagrams. We're not going to try to explain some of the diagrams. I've tried to do that in prior podcasts and was told, Don't explain diagrams on the podcast. It's too
Okay.
hard. But I think we can still talk through some examples that are relatively simple. But generally a hybrid arbitrage arrangement is defined as one of three things: a deduction non-inclusion arrangement, a duplicate loss arrangement, and a duplicate tax recognition. It's really the first two that I think could create a potential number of traps for the unwary.
Right.
But let's start with the deduction non-inclusion arrangement. I think that's probably the one that's most commonly known. But for Pillar 2 purposes and parlance, what is a deduction non-inclusion arrangement?
Yeah, so the deduction non-inclusion arrangement is basically first an arrangement whereby one constituent entity provides credit, and directly or indirectly so, to another constituent entity, and that constituent entity basically takes a deduction for purposes of its financial statements. And then you test the other side of that instrument to see whether or not there was a commensurate increase in the taxable income and a commensurate increase in the financial statements. And if you fail either of those, right, so you don't have a commensurate increase in either tax or financial statements, you have a deduction non-inclusion arrangement.
All right, and so maybe just give an example of a deduction non-inclusion before we even get into some of the common issues and traps for the unwary. What were they really targeting when they came up with this rule?
I mean, the easiest example of this is preferred equity, the most simplest. And with preferred equity, U.S. tax and other jurisdictions' tax principles treat that as equity, whereas GAAP would treat that as a debt instrument.
Obviously, depending on the terms, but very common for preferred to be treated as debt for book purposes.
Yeah, and so on the issuer side, you see a deduction in its financial statements, but on the tax side of the other side of the instrument, there is no commensurate increase in taxable income because it's being treated as equity. And
assuming there's a participation exemption.
Assuming there's either a participation exemption or our previously taxed earnings and profits types of rules, which under the U.S., which would exempt a return of that on that stock. So you wouldn't have a commensurate increase in the taxable income, and then you would call this a deduction non-inclusion arrangement. And what's the outcome of that? You basically remove the expense from the calculation for the safe harbors, right? Which should have an effect of decreasing your simplified effective tax rate and possibly causing you to fail the safe harbors in that jurisdiction. Now, what it doesn't do is it doesn't turn off the income on the other side of so if you have book income on the other side of the instrument, that remains within your financial statement calculation.
Yeah, so it has that one-sided effect. The idea is that there's disparity between the treatment, between the two jurisdictions. And the consequence, if you do have one of these deduction non-inclusion arrangements, is that the expense deduction comes out. And therefore, your GLOBE Pillar 2 rate, or specifically I should say your safe harbor rate, is going to move up. And again, these rules apply in the context of the safe harbor, but I think the concern of the OECD was that there was concern that taxpayers were manipulating for purposes of the safe harbor, which is why they started with the focus on this.
Yeah, and I think there's like a fundamental policy thing there, right? Like they started with the safe harbors because of these were this was basically the technology that taxpayers were using now, and then they paused on the full guidance, which was to come later because that was going to be more permanent guidance. But it sort of left us in a place now where the safe harbors have become more complicated because we don't have the guidance in the full Pillar 2 rules.
Right. So let's talk about, I want to unpack a little bit. I think it's a great example, the U.S. preferred stock, or just the preferred, I say U.S. preferred stock, but in the U.S. now where we have a participation exemption post TCJA, many countries around the world offer a participation exemption. Many investors in financial services across different industries use preferred stock, often in the context of joint ventures, but may also be used in a wholly owned context. And what's interesting about preferred stock is that generally preferred stock is not a tax planning strategy. It is an investment strategy. And so in most jurisdictions, when you invest in preferred stock and then there's a yield or a dividend on that preferred stock, for tax purposes, it does not result in a deduction. So there was really nothing that was intended from a tax planning perspective, often in the context of these preferred stock arrangements.
Right.
But from a book perspective, because Pillar 2 is focused on book,
yeah.
it can, and if it's treated as debt for book purposes, it creates a deduction for book. If all of these were consolidated, for example, there's really no consequence, right, to the overall enterprise of this book deduction, but it creates an issue under Pillar 2.
That's right. I mean, this is the fundamental problem with like the multiple dimensions in which we start, testing things, and it stems from the concern that this is a jurisdictional tax, right, imposed, a top-up tax based on the income in that particular jurisdiction, so that this doesn't consolidate it out in the overall financial statements. You're basically just looking at the singular jurisdiction for this purpose.
Yeah, so this one I think is a really big trap for the unwary, particularly for those taxpayers, and a lot of them believe that they can rely on the safe harbor. One of the things that needs to be done is, do you have any preferred stock? How is that treated for book purposes? How could that impact your safe harbor calculation?
Right.
Another example that you give in the article is potential discrepancies as a result of foreign exchange hedging.
Yeah, so the guidance basically says, hey, you need to have a commensurate increase in the taxable income. And then they put some guardrails around what is a commensurate increase. So one of the things that isn't a commensurate increase is if you're getting a deduction against that increase that you got. But it's supposed to be a one-for-one increase. So if you're getting $100 of a deduction, it should also be matched up with $100 of income. And what happens, what I was pointing out with that FX example was if you have a simple loan, which is denominated not in the functional currency of the entity, you could have a situation due to FX volatility, which would lead to recognition of a different amount on one side of the instrument as opposed to the other side of the instrument. And if that is the outcome, then you arguably have a deduction on inclusion arrangement.
Because you end up with the deduction for FX on one side, and if
Right.
the other side, the holder, if that's in their own functional currency, if the debt instrument is in their functional currency, they are not going to have a corresponding.
Right. For instance, you get $100 of deduction. On the other side, you had $100 of income, but you suffered FX loss, and now it's not. You got a $10 FX loss, and so it's really $90 of income remaining. So you have a $10 of a potentially a deduction on inclusion arrangement.
Yeah, another trap for the unwary.
I think this one is the one that got most attention.
Yeah, certainly. And then also, one of the requirements with respect to the deduction on inclusion potentially deals with the use of valuation allowances. So maybe talk about that and what are some of the challenges with that.
So this one was interesting to me particularly because as I read the model rules and the commentary, valuation allowances were essentially ignored. And then when I started reading the safe harbor rules, I saw that the valuation allowance actually has a role to play here. So if you have a commensurate increase, it isn't deemed a commensurate increase to the extent you are using a deferred tax attribute with a valuation allowance on it. And that test, the way that it's written, it's not a factual test, it's a hypothetical test. So the question you ask yourself is, do you have a valuation allowance on that deferred tax attribute, or would you have a valuation allowance on that attribute if the instrument was not in play?
Yeah,
and
go ahead.
that causes an immense burden. As you can imagine, if you have, say, 4 loans coming into an entity and the income is being shielded with a interest expense carry forward attribute, which has a valuation allowance on it. Well, which of the 4 loans is a deduction on inclusion arrangement, or are all of them deduction on inclusion arrangements?
And this is very common, and particularly in the US, for example, where we have limitations on our interest expense that frankly do not expire. So relatively uncommon to have a VA, but you could. NOLs, where oftentimes there may be a VA. Just any time you've got a potential VA, you've got this potential issue.
And you got to ask yourself this hypothetical question, which becomes very difficult to think through.
Okay. So one of the things that was introduced going back, to the BEPS, to the ATAD 2 in particular, was something called the dual inclusion income exception. And we see that in the duplicate loss arrangement rules. We don't see that in this rules. Talk about what is a dual inclusion income exception. It's not easy to say, certainly.
Yeah.
But what is it? And I'm going to ask, should it be in the Pillar 2 rules?
Right. So the dual inclusion income exception is a bit of a mouthful, but the dual inclusion income exception basically tests, well, if you have a deduction on inclusion arrangement, but you also have income that is being duly included, that should exempt you from having the deduction being denied under the deduction on inclusion arrangement, because you're basically subject to tax twice on the other income, and you're really just using the deduction to offset income that is being included twice.
Exactly. And I think that's the important point. And I mean, man, I have PTSD from thinking about this in the context of these ATAD 2 rules. And I think this is one of the things that's challenging for taxpayers is a lot of these issues were identified and sort of many of them were resolved in other jurisdictions. But the point is that if you have a deduction in one jurisdiction, the concern was that there was no inclusion in another jurisdiction. But if you have multiple inclusions or inclusions in multiple jurisdictions, in 2 jurisdictions, then effectively the dual inclusion should offset the expense.
Exactly, because it's neutralized at that point.
It's neutralized. There obviously must not be any sort of planning, or the intent of the rules is to go after this deduction on inclusion. Well, you actually have an inclusion in 2 jurisdictions.
Right.
So should this be incorporated into the Pillar 2, both hybrid and then maybe ultimately into the final rules?
I mean, my perspective is why shouldn't it be included in there? I mean, it was already included in the Action 2 report, and so seeing it not be reflected here is sort of, at least I'm curious as to what is the rationale behind that. I mean, from my perspective, I think it makes sense to have it included.
And it's a good point, is that there does seem to be some discrepancy between these hybrid arbitrage arrangement rules for Pillar 2 and what happened during the BEPS initiative on Action Item 2 and ATAD 2, and sort of reconciling those, I think, could resolve a number of the issues that we're seeing with Pillar 2. Maybe the last thing before we move on to duplicate loss arrangements are, you mentioned some challenges with back-to-back arrangements, and specifically with cash pools, where maybe one of the entities in the chain exempts the interest income from local taxation. I mean, this would not be uncommon, in certain jurisdictions that exempt maybe foreign source income, that have a territorial regime, for example. What are the issues with some of these back-to-back arrangements?
I think this is sort of, it stems out of an issue that's also present in the 327 rule as part of the full Model 2 rules. And it's basically how they've defined the term arrangement. And in the Model rules, it's the intragroup financing arrangement, but here it's just arrangement. But the arrangement is a direct or indirect provision of credit, right? And you could have an indirect provision of credit from one entity to the other entity. So you could have a cash pool in the middle, and so that therefore it's an indirect provision of credit. But if one of the entities, which is long in the cash pool, sort of has an exemption system, as you outlined, and you outlined, that doesn't give you a commensurate increase in the taxable income in that entity, and you have, say, 5 loans on the other side of the cash pool, do you have all 5 of those loans now treated as deduction on inclusion arrangements? And
you get to pick which one?
Do you get to pick which one, or do you prorate them? And what if one of those entities takes the proceeds and equity contributes into another entity, which then on lends? And how far do you trace this indirect provision of credit?
Yeah. Another big challenge, and again, like for listeners, all of this is in the context of the safe harbor rules, which were supposed to be simplified and safe for taxpayers. All right, so let's move on to a duplicate loss arrangement. I'm probably dating myself, but I think back in the day, this was called the double dip.
That's right. Double deduction, double
deduction. Now it's a duplicate loss arrangement. But what is a duplicate loss arrangement?
Yeah, so it's basically an expense or loss that you have in one jurisdiction that is also being used in another's jurisdiction, either tax system or the other dimension, book income, right? So if it's a loss or expense that's being duplicated in either one of those other dimensions, essentially.
And this is particularly something that we see a lot with U.S. MNCs, for example, that have check the box entities that have a loss. You mentioned this earlier. We have our dual consolidated loss rules, which have been around for decades, that are really focused on this type of arrangement. But Maybe from a Pillar 2 perspective, how does the OECD sort of frame these duplicate loss arrangements, and maybe even specifically the dual inclusion income exception, and how does that work within these rules?
Yeah, so the trouble with these rules, as you mentioned, comes with the dual income inclusion exception. And for duplicate loss arrangements, there was provided an exception for dual income inclusion. But it was a very narrow exception, and it doesn't really operate in a lot of circumstances. So for instance, if you just have a US MNC with two branches, one profitable, one loss-making, the loss-making entity would be giving rise to a duplicate loss arrangement because that loss is presumably being used in the US and offshore. But on the other side, the income entity is going to have income that is being used in the US taxable income and the foreign jurisdictions taxable income. And so you would think that that would net out because Pillar 2 is computed on a jurisdictional basis, right? And even for the safe harbors, you compute a simplified ETR approach, which is again jurisdictional in nature. But the dual inclusion income exception asks you whether or not that dual inclusion income is in the same entity that suffered the loss. And so in this example with two branches, you have two different entities, so you don't have the dual income inclusion exception apply.
So how would the OECD fix this, Raza?
Yeah, I think the easiest, well, there's another problem that we should go through, but like on this one, shouldn't it be jurisdictional in nature is the
100%.
question that if we're starting from a base that everything is jurisdictional, then why would you limit a dual inclusion income exception on a constituent entity by constituent entity?
And I listen, I think it's a great point that you raised in the article. I think it's been raised by others that from a policy perspective, it absolutely makes sense to do this at the jurisdictional level, not the constituent entity level. It's just the hybrid arbitrage arrangement rules in the safe harbor use the word constituent entity, which puts taxpayers, and you mentioned a US MNC, it could be any parent company jurisdiction. You've got two different branches, those are two different CEs, one's positive, one's negative. You potentially have an issue with that, with the entity that's a negative, that's at a loss.
Absolutely. I mean, we should go to another issue that is caused in this dual inclusion income, right? If you have hybrid entities in your structure and you have disregarded flows, those disregarded flows may not create dual inclusion income. And so you may not be able to use that disregarded income that you're seeing as triggering that dual inclusion income exception, and therefore you would still be in the, you would still have a duplicate loss arrangement. The easiest example of this is if you have a cost plus service provided in a foreign jurisdiction, which is a hybrid entity. So you have a cost plus flow, which is disregarded, so there is no income inclusion in the parent jurisdiction, but you have operating expenses of the cost plus service provider, which are being taken into account in the financial statements of the constituent entity, the cost plus service provider, and then also in the parent entity's financial taxable income. And so, a very simple flow that is very common could easily end up becoming a duplicate loss arrangement because you don't have this sort of exception tailored.
Yeah, the way I think about this is that those rules were intended to provide sort of a double deduction, and particularly, with the U.S. where we have disregarded entities that can create hybrid entities, but there's certainly other examples of that in other jurisdictions. But sort of the irony is that when you have disregarded income that is taxable in that recipient jurisdiction or that jurisdiction where you're testing whether you have a duplicate loss arrangement, you don't get credit for the income that is actually recognized in that jurisdiction because it is disregarded for U.S. tax purposes. I believe that when we, in the ATAD 2 and the implementation of ATAD 2, that a couple of the European jurisdictions specifically addressed that.
They did. So for example, the United Kingdom, the UK, when they were adopting ATAD 2, basically looked at this and saw this as an issue, and they solved for it. And the way they solved for it is they basically treated that cost plus service provider as an opaque entity and tested whether or not you would get a deduction there. And if that was the case, they would exempt this from having a double deduction outcome.
I think both the UK and
Ireland has similar rules as well. Yeah.
All right. So the last one in the duplicate loss arrangements are application to CFC regimes. And obviously, as U.S. practitioners, we're always thinking about Subpart F. We now obviously have GILTI to think about, but there are a number of other jurisdictions around the world that also have CFC regimes.
Right.
What is the issue with CFC regimes?
Yeah. So the CFC regime produces an income inclusion in a different jurisdiction. And I think the point there is if you have an income inclusion amount under a CFC regime, why should it not similarly give rise to dual inclusion income and offset, the duplicate loss that you ostensibly have? And
on that item.
On that item. And in the U.S. space, when we think about DCLs, we have inclusion on stock type of rule, which is currently up for debate, but it exists as of today that you can have an inclusion on stock, which is helpful in your DCL computation. But in the safe harbors, there is no recognition of CFC, particularly hybrid arbitrage arrangements, there is no recognition of CFC regime inclusions. But if you go back to ATAD 2 again, and you look at this BEPS Action 2 report, if you had a Subpart F income inclusion, that would give you credit to not have a deduction on inclusion arrangement. And so the thought that I was raising here is if you imagine a structure where you have a loss in one jurisdiction, but that entity owns another CFC which has an income, which has an item of income, and that item of income is giving rise to an inclusion, why should not that be taken into account when considering whether or not you have a duplicate loss arrangement?
Right, and I think, was it Australia?
That's right. Australia is the one that gives you credit for inclusions under Subpart F, but perhaps not under GILTI. Now, the interesting point here is GILTI has been acknowledged as a blended CFC regime in the full Pillar 2 rules. So, is it a CFC regime for the purposes of this particular item, which is taxpayer friendly or not?
All right. So let's just talk for a couple minutes on where are we going. So we know that we are expecting future administrative guidance, right? Presumably the G7 agreement, which we've talked about on a prior podcast, is highest priority for the OECD to figure out the architecture of this side-by-side regime between US GILTI and the Pillar 2 rules. We also know that taxpayers are clamoring for permanent safe harbors. The OECD has been talking about for months, over a year now, that we're going to be getting this hybrid arbitrage arrangement analysis. So when all of this is coming out, who knows, right? We've heard U.S. Treasury talk about the desire to try to get things out by September. We've heard other folks at the OECD say by the end of the year. I'm not going to ask you to predict when the next administrative guidance is.
I couldn't either.
You couldn't. None of us can.
Yeah.
But obviously, there are a number of very important initiatives that both taxpayers and advisors are waiting for. Maybe the last question I'll leave you with, and I know you've thought a lot about this, is that we haven't talked a ton about this, is how the U.S. rules are going to work in the context of Pillar 2, and particularly the interactions between the U.S. sort of anti-arbitrage rules. So we mentioned 267 Cap A, 245 Cap A, DCL.
Right.
What can and should we expect from a U.S. perspective?
Yeah. So if I look at the G7 statement, right, we saw the promise of material simplifications, but we also saw one of the principles that mentioned that risks of base erosion and profit shifting will be addressed. So it raises a question whether these rules, as previously mentioned, are going to be brought into the Pillar 2 rules,
Into the model rules from the safe harbor.
right? Or are they going to be somewhat simplified and perhaps not, or a simplified version of those brought into the Pillar 2 rules? So I think that's a large question that's out there. From the U.S. side, there's really three places we see a lot of interaction. So we have the 245 Cap AE, which is our hybrid deduction accounts for our participation exemption system. Those rules take into account whether or not a deduction is taken in a foreign jurisdiction with respect to a hybrid instrument. I think there needs to be some thought given to whether QDMTTs or IARs, for instance, are going to be taken into account.
Yeah, how does Pillar 2
Yeah, right. And
work with those rules?
exactly, and there is some level of circularity there because if 245 Cap A denies you a deduction, well then did you really have a hybrid arbitrage arrangement, and vice versa, right? Like it kind of goes in a little bit of a circle. Similarly, in 267 Cap A space, Treasury mentioned in some proposed regulations and the notice that whether or not QDMTT is taken into account as a foreign tax law for those provisions is something that the Treasury is giving thought to. Now, that was under the last administration where we got that. Now we're under a new administration, and the new administration sort of has this position that that the U.S. system adequately protects against base erosion and profit shifting. And so I think there is a call for Treasury to make and think about these rules with sort of that fresh perspective, whether or not, or how to address these. The last one is the dual consolidated loss regimes, right? We got guidance in proposed form. Yeah. We also had the notice 2023-80 that gave us some relief, and that relief was extended in the final DCL regulations. Again, like that's not, more relief was promised under that when those regulations were going to be finalized. So I think Treasury again needs to think about that and provide more guidance on those space.
I mean, these are just incredibly complicated issues. Very, very important. I think the kind of these traps for the unwary, that's a term that I like to use,
yeah.
Sort of these issues that are relatively common in a variety of different taxpayers that may have been set up with absolutely no intention to do any form of base erosion can still potentially be caught, and then how all of these rules interact now with the U.S. as how these Pillar 2 rules interact with this U.S. side-by-side system. A lot to come, and I think
That's
maybe
right.
the ask is for, as the OECD is thinking about bringing these rules into the model rules, certainly addressing some of the issues that sort of came out of the woodworks as part of ATAD 2, I think would be very helpful for taxpayers and frankly tax authorities to actually administer these rules.
Absolutely.
All right, well, Raza, thank you very much for coming on. Really enjoyed your article. I thought you gave some very good practical points, and appreciate you coming on the Cross Border Tax Talks podcast.
Pleasure to be here.
So thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you, Raza Janjua, Director in PwC's International Tax Services Practice and the author of the recent Tax Notes article, Safe Harbor in Stormy Waters, Hybrid Arbitrage Arrangement Guidance. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.